this is about mortgage interest rate. Let's start. Let me write the title, mortgage interest rate. So, the mortgage interest rate consists of, let's say it's X of the referential rate, and it can go up and down, it depends on the market. Actually the economy in the whole country, plus the margin of the bank. Let's say the margin of the bank in general is going to be always fixed, with small tiny exceptions. For example, if you took the very good deal with like promotion of the bank and they told you you're gonna keep lower margin until you're gonna keep the policy, the insurance, life insurance policy. So let's say after a few years you cancel it, you stop to pay, and they have a right, if you have this clause in a contract, that they're gonna write it up. But it's like very exceptional case. So in general, the one you took and you have it on the contract is gonna be applied to your mortgage forever until you jump, you refinance to that other bank. So referential rate can go up and down, as I said, and we have three types here: Euribor, Libor, and Vibor. What does it mean? That's just the short name of Euro interbank offered rate, London interbank offered rate, and Warsaw interbank offered rate. For PLN, we're gonna base on PLN with Vibor. With Polish currency, we're gonna use just Vibor, right? PLN. If your salary and your mortgage is gonna be in Swiss franc, but we don't do Swiss franc anymore, so it's gonna be only for GBP, and Euribor for Euro. That's obvious. If your salary, and because of that your mortgage is going to be in one of those currency, we're going to be based on those referential rates. Both of them, they are negative, they are below zero. Wibor right now it's a little bit slightly above zero, but it may change any month. So it can go up and down, and the main rule is like this: if one of the components of the sum changes, the sum by itself, the overall sum will also change. That's obvious. So the overall interest can go up and down. What else to add here? Here nothing more, but to understand how they may affect your installments. Let's say historically, I'm not gonna touch Libor and Euribor. I'm just gonna speak about Warsaw interbank offered rate here. So historically, I would say it was somehow like this. Right now we are quite low, 7, let's say approx 6, 5%. So it's been quite high. It's like, let's say, over past decade, this period of time. I don't want to go even more back there. So it can like kind of, maybe it's not like sinusoidal changes, but it kind of go up and down with time. Like in every single economy, you have recession, you have sometimes a very good period of time, everything grows, sometimes it's like a bad period. So it can also affect the rates, the inflation, the referential rates in the country. You can do nothing about that. The National Bank is going to always, through, in this case, RPP, NBP is our national bank, NBP, National Polish Bank, and RRP is like Commission of Fiscal Monetary Policy. NBP is the same like ABC for Europe, European Central Bank, and Fed for United States. So they are like, let's say it's kind of one body, and they're making decisions about the further future. What is affecting your wallet directly because you're based on one of these factors. So they for example, RPP, this jury, they're gonna have a meeting each month of the year. So if they're gonna agree that they're gonna rise up the referential rate in Poland, you're gonna see very shortly difference up or down on your installments. We can have a VBOR 3-month average or 6-month average. It means that this one's gonna change, it will change 4 times per year, that one only twice. So if the rates go up, you're gonna see it slower. It's gonna slower affect your wallet, your installments. But anyway, at the end, you're gonna pay the same, right? So to understand on this point that it's really serious, and you have to keep it in mind that if you are based on the variable one, there is one more episode about a fixed versus variable one, the installment. So that one is about variable one based on the referential rate. Reference rate, it can always hit you when they go up. Right now they are really low. How to protect yourself? Go to the video called fixed versus variable one, and then you can pick for at least 5 years the fixed rate. Not based for this, but on the forecast how the market's gonna be, how the banks they predict they can offer you fixed guaranteed payment for at least 5 years. It's worth to consider. And then one more thing about the refinancing. It's also important. Let's say that's the kind of like regular interest, overall regular interest. That's the timeline. It's a time here. That's the interest. So with time, as I said, the reference rate can go up and down. When it was very high, the bank's margin was quite low. I don't want to put any numbers here because I want it to be to be always up to date, for a long amount or years. So in generally speaking, it's gonna be margin rate. Let's call it just M. So if currently the rates are very low, the banks got a lot of space, even for example up to 3 times M, to charge you with the higher. I'm pointing here because here was, as you remember, the first column of the bank's margin. So on the previous video, so they're gonna be able to charge you even 3 times more expensive product, the margin, the mortgage by itself, but still the overall interest, the total one, this X, is gonna be way lower than the person who was paying the mortgage who's paying installments back there on 7.65%. So, making a long story short, higher rates are, then lower the margin of the bank probably is gonna be. It's just the general rule. So right now they're quite high because we have very low referential rate. But if you take mortgage right now, you can say, okay, my installments are very low, but the price of the mortgage is quite high of the product itself. So with time, if the rates, I'm saying if because it can go even down or be negative, if they would go up, then we can make assumption based on the historical charts that again the margin is gonna be like 2 times M or just 1 times M. They're gonna decrease because of the referential rate will go up, so the space for bank to earn money, to take the revenue on you, is gonna be smaller and smaller, because otherwise it would be too scary for you to take the mortgage. You wouldn't agree on this interest rate. You would look for different options, or you wouldn't buy your apartment or house. That's a general rule. Why I said that? Because this is very critical to understand in order to be ready to refinance, to go from A to B. You remember to change the bank. If you are right now here and the bank B with time is gonna have way better offer on the market, then you're just gonna jump to another bank with our help. That's it. Everything is said here. And if you have more questions, then we're gonna answer to you on the meeting with all the things you need to know. Thank you for your attention.